Would you put your retirement fund into a company that loses money on every dollar it makes? Yeah, actually, you already might be. Welcome to another episode of TechNate News. Today we are talking about two of the most hyped IPOs in history and why the excitement around them might be hiding a much bigger problem. Let us start by giving credit where it is due. OpenAI built ChatGPT, the product that basically created the consumer AI category as we know it. By early 2026, the monthly revenue of OpenAI had reached around $2 billion, with an annualized run rate exceeding $25 billion. That is a genuinely staggering number for a company that barely existed a decade ago. And then there is Anthropic. Anthropic went from a $1 billion revenue run rate in December of 2024 to roughly $47 billion by May of 2026. That is one of the fastest revenue scaling trajectories ever recorded in enterprise software. Full stop. Both of these are extraordinary businesses. That is not in question. What is in question is what happens when they try to become public companies in the same tightly packed window, chasing the same investors, competing for the same capital, while burning cash at a pace most industries have never seen. So here is a question worth asking. What are you actually buying when you buy this stock? You might say the company that makes ChatGPT or the company that makes Claude, but look at the numbers, and what you are really buying is a bet. A bet that hundreds of billions of dollars in compute spending eventually turns into durable profit before the money runs out in an industry where the core product, an AI subscription or an API call, is becoming more and more of a commodity every single month. That is the thesis of this video. Two of the most valuable private companies on earth, both racing their own cash burn to the finish line. Let us talk numbers, because this is where it gets interesting. In 2025, OpenAI generated around $13 billion in net revenue, but posted a net loss of $38.5 billion. Now, to be fair, a huge chunk of that, nearly $42 billion, came from a one-time accounting change tied to OpenAI converting from a non-profit to a for-profit company. That is not the same as pure operating burn. But even stripping that out, this is a company spending far more than it earns, with executives themselves saying profitability is not expected until the end of the decade. OpenAI has also committed to more than $1.4 trillion in data center and infrastructure spending over the coming years. $1.4 trillion. One estimate from HSBC puts the funding gap, the money OpenAI still needs to raise even after a successful IPO, at over $200 billion. Now compare that to Anthropic. The burn at Anthropic has reportedly run at around a third of its revenue and trending down, with the company guiding toward its first positive operating quarter in the middle of 2026. That is a very different trajectory. One company is heading toward the black. The other is committing to spend more than the GDP of most countries before it even gets close. But do not think Anthropic is walking into this debt free of risk either. The last private funding round for Anthropic priced the company at $965 billion on a $47 billion revenue run rate. That is about 20 times current revenue. Public markets do not always forgive multiples like that, especially in a sector this competitive. Speaking of competitive, let us talk about the web of money flowing between these companies, because this is the part that should raise an eyebrow. According to the IPO filing from SpaceX, Anthropic has a deal to buy roughly 325,000 NVIDIA chips through the Colossus data centers at SpaceX at $1.25 billion a month, running all the way through 2029. Meanwhile, chip makers are investing directly in the labs that buy their chips, and cloud providers are taking equity stakes in the very companies renting their compute, when the customer, the investor, and the supplier are all the same handful of companies. It is fair to ask how much of this revenue reflects real market demand, and how much of it is just money moving in a circle, and the competition is not slowing down. The Gemini product from Google grew its web traffic share from 5.7% to 21.5% in just 12 months, while the share held by ChatGPT dropped from 86.7% down to 64.5% over that same period. Meta is undercutting everyone on price with open source models. xAI just folded into the IPO of SpaceX. This is a crowded field, and the moment your product becomes a commodity, the winner tends to be whoever can burn cash the longest. Now let us talk leadership, because this is where the story at OpenAI gets genuinely concerning. Of the 11 original co-founders of OpenAI, only two remain today: Sam Altman and Greg Brockman. Chief Scientist Ilya Sutskever, gone. Chief Technology Officer Mira Marathi, gone. Chief Research Officer Bob McGrew, gone. At least 12 senior executives left in 2025 alone. And since April of 2026, at least 11 more senior leaders and project heads have departed, including Product and Business Chief Fiji Simo, Operating Chief Brad Lightcap, and Business to Business Chief Technology Officer Srinivas Narayanan. To be fair, not all of these are red flags. Fiji Simo stepped back due to a worsening health condition, and Marketing Chief Kate Rauch left to focus on cancer recovery. Those are personal, not strategic, but even accounting for that, this is a leadership team that has been almost completely rebuilt in under 2 years, right as the company heads toward the most scrutinized moment of its existence. Here is the twist that changes the whole picture. OpenAI was originally racing toward a public listing by the end of 2026. That is no longer the plan. Reports now say OpenAI has pushed its IPO back to 2027, citing concerns about market enthusiasm, cooling, and increasing pressure from Anthropic. Think about what that means. The clock on the cash burn at OpenAI keeps running. The infrastructure commitments keep piling up. But the payday that is supposed to fund all of it just got pushed back a year. So where does that leave us? Two of the most valuable private companies in history, both asking public markets to fund infrastructure commitments that in some cases are larger than their own market cap, in an industry where the core product is getting cheaper and more commoditized every quarter, with one of them delaying its own listing because the timing suddenly does not feel right. Maybe this is a generational buying opportunity. Maybe it is the clearest sign yet that the AI boom has entered its riskiest phase. I am not going to tell you which one it is. This is not financial advice, and if you want to buy the stock when it lists, that is your call to make, not mine. But I would be paying very close attention to how these two companies handle the next 12 months. So what do you think? Is this the start of the biggest tech IPO run in history, or are we watching the first cracks in the AI bubble show up in real time? Let me know in the comments below. If you like this video, consider subscribing. You have been watching TechNate News, and I will catch you in the next one.